Welcome to the deep dive. Today we're zeroing in on earnings per share, EPS.
That's right. It's that key number telling you how much profit a company makes for each share out there. Really fundamental for understanding profitability.
Exactly. Looking at how it's handled under the two big accounting standards, IFRS, International Financial Reporting Standards, and US GAAP.
Yep. Generally accepted accounting principles in the U.S. And our mission, really, for this deep dive is to unpack that comparison. We want to pull out the similarities, sure, but maybe more importantly, those interesting differences.
Between how they calculate and present basic and diluted EPS.
Precisely. Looking at them side by side like this should give you, the listener, a much clearer picture than just looking at one in isolation.
Okay, let's start with the big picture then. Presentation, scope. Who needs to report this stuff? It seems like IFRS and US GAAP are pretty aligned here at the start.
They are, largely. Both require it for publicly traded entities or companies that are in the process of going public. Basic and diluted EPS.
And it has to be prominent, right? Not hidden away.
Absolutely. Equal prominence. Right there in the main statement, reporting profit or loss. Or under IFRS, it might be profit or loss, and OCI, other comprehensive income.
And that applies for each class of ordinary or common shares if they have different rights to profits.
Correct. Got to show it for each class with different rights. Transparency for different types of owners.
Makes sense. What if a company sells off a part of its business? Discontinued operations.
Yes. Both standards say you need separate EPS disclosure for those, either right on the face of the main statement or, detailed in the notes.
So you can clearly see the results from the ongoing business versus what's been stopped.
Exactly. And interestingly, if a company voluntarily presents EPS, maybe a private company, they still have to follow the rules. Both IFRS and US GAAP say if you show it, you calculate and present it according to our standard. No making up your own method.
Got it. Now, you mentioned different classes of shares. The source talks about a two-class method. What's that about?
Okay, so the two-class method is used when you have more than just plain common stock, maybe different classes of common shares or other things considered participating equity instruments.
Things that share in the dividends alongside regular shareholders.
Basically, yes. Both standards use this method to allocate the profit or loss fairly among these groups based on their specific rights to earnings that haven't been distributed yet, like slicing the pie fairly.
Okay. And is there a difference in how they apply this?
There is. US GAAP's application is, broader. It applies the two-class method to all participating securities. Doesn't matter if they're technically equity or even classified as liability.
Oh, interesting. Even liabilities.
Yep. And US GAAP generally has more detailed guidance on exactly how to make those allocations.
Right. And just confirming, EPS figures need to be shown for all the periods presented in the financials.
Absolutely, under both. For comparability, you need to see the trend.
Okay, good overview. Let's get into the nuts and bolts now. Basic EPS, how is that calculated at its core?
The fundamental formula is profit or loss attributable to the ordinary or common equity holders, divided by the weighted average number of those shares outstanding during the period.
Profit per share, essentially.
That's the idea. But you often need to adjust that profit number, the numerator.
Adjust it how?
Well, under both IFRS and GAAP, you have to subtract the after-tax dividends on any preference shares that are classified as equity, because that profit went to them, not the common shareholders.
Okay. And what if those preference dividends weren't actually declared or paid?
It depends if they're cumulative or non-cumulative. The treatment's the same under both standards here.
Right.
Cumulative dividends get deducted whether they're declared or not because the obligation exists.
Right.
Non-cumulative, only deducted if they've actually been declared by the reporting date.
And going back to that two-class method, how does that affect the profit numerator for basic EPS?
It means that the profit or loss for the period gets allocated out to the different classes of common shares and to those participating equity instruments we mentioned, all based on their rights to share in undistributed earnings.
So the numerator reflects only the portion truly belonging to the basic common shareholders being measured.
Precisely. It's about getting the right earnings figure for the right shares.
Now here's a tricky area mentioned. Unvested share-based payments. How do they fit in?
Yeah, this is interesting. If those unvested awards give the holder rights to dividends before they vest non-forfeitable dividend rights, then both standards treat them as participating securities.
So they get allocated a share of the earnings under the two-class method, even before vesting.
If they have those dividend rights, yes. It acknowledges their participation in the company's earnings already.
Okay, let's flip to the other side of the fraction, the denominator. The weighted average number of shares. How are share transactions during the year handled?
Pretty straightforward and aligned. Both IFRS and GAAP include shares in the weighted average from the date the transaction occurs. So if shares are issued mid-year, they're only counted for the portion of the year they were outstanding.
Makes sense. And treasury shares, the ones a company buys back.
Definitely excluded. Under both systems, treasury shares are not considered outstanding for EPS calculations.
Okay. The source also mentions a company's own shares held by employee benefit plans. That sounds specific.
It is, but again, there's alignment. It hinges on whether they're qualifying plan assets. If the shares held by the plan are essentially offsetting a plan obligation, they're not treated as treasury shares. They're effectively still out there from an economic perspective.
But if they don't meet those qualifying criteria?
Then they are treated like treasury shares, deducted from the outstanding count.
All right. What about shares that might be issued in the future? Contingently issuable shares.
Right. These are shares issuable for little or no cash, but only if certain conditions are met. Both standards agree. Include them in basic ETS only when all those conditions are actually met.
So not before the conditions are satisfied.
Correct, for basic EPS. However, if shares are issuable just based on the passage of time, they're treated as outstanding from the start because time passing is certain.
And those unvested shares requiring only service. We mentioned them for the numerator. How about the denominator?
For basic EPS, both include them in the denominator once the service condition is met. Unvested options, though, generally only get included once they're exercised.
But there's a nuance.
Yes. If the options become issuable for little or no extra cash once vesting conditions are met, they're included in basic EPS as soon as those conditions are met, similar to contingently issuable shares.
What if shares are only partly paid up?
Both treat them as a fraction of a share for basic EPS. The fraction is based on their dividend participation rights compared to a fully paid share.
And shares subject to recall by the company.
Generally excluded from basic EPS until they're no longer recallable under both. But here comes a key US GAAP difference we need to flag.
Okay.
Mandatorily redeemable common shares and shares under certain forward purchase contracts. US GAAP only excludes these from basic EPS if the deal involves physical settlement for a fixed number of shares for cash.
So if it's not fixed or settled differently, they might stay in basic EPS under US GAAP.
Potentially, yes. And also, US GAAP specifically says shares related to written put options where the company might have to buy back shares are not excluded from basic EPS. That's a divergence from IFRS.
Definitely noted. Okay, that covers basic EPS. Let's move on to diluted EPS. What's the core concept here?
Diluted EPS starts with basic EPS, but then considers the what if. What if all those potential common shares, things like stock options, warrants, convertible bonds, were actually turned into common stock? It adjusts both the numerator and denominator.
To show the maximum potential dilution.
Sort of. It shows the impact if they are dilutive. Potential shares are only factored in if they decrease EPS or increase a loss per share from continuing operations. You test each one.
So anti-dilutive ones, those that would increase EPS, are ignored.
Correct, under both. Each potential share issue is looked at separately to see if it drags the EPS number down.
Now, the source highlighted a specific US GAAP difference regarding the year-to-date calculation. Can you unpack that?
Right, this is quite nuanced. Under US GAAP, the year-to-date diluted EPS uses a weighted average of the incremental shares from each interim period. This means an instrument could be anti-dilutive in Q1, say, but become dilutive for the year overall.
So it might get included in the year-to-date US GAAP diluted EPS, even if it wasn't dilutive in every single quarter.
Exactly. IFRS doesn't have that specific mechanism regarding excluding potential shares if there's a year-to-date loss. So US GAAP can sometimes pull in dilution earlier or in situations where IFRS might not for the year-to-date figure.
Interesting. And generally, determining if something is dilutive is done period by period.
Yes, both require independent determination for each period presented, with that US GAAP year-to-date calculation being a notable exception or overlay.
How are the earnings the numerator adjusted for diluted EPS?
Okay, so start with the basic EPS numerator. Then, for any dilutive potential shares, you add back the after-tax effect of any dividends, interest, or other items related to them that were originally deducted. Think convertible bonds. You add back the after-tax interest expense because if they converted, you wouldn't have paid it.
That's the if-converted method.
That's the term often used, especially under US GAAP, yes. You basically adjust earnings for the impact of the assumed conversion.
What about the costs of share-based payment plans? Does that get adjusted?
Generally, no. The numerator usually isn't adjusted for the expense recognized for equity-settled share-based payments under either standard. However, US GAAP has a wrinkle for liability classified awards.
Ah, what's that?
The remeasurement expense for those liability awards is added back to the numerator under US GAAP, unless the company assumes share settlement, and that's more dilutive, a specific point there.
Okay. And the denominator for diluted EPS, how does that change?
It includes the basic weighted average shares plus the weighted average number of additional shares that would have been issued if all those dilutive potential shares were converted or exercised.
And when is this assumed conversion date?
Assumed to happen at the beginning of the period, or if the potential shares were issued later on their issue date. That's consistent between IFRS and GAAP.
Let's talk options and warrants. How are they handled? The treasury share method.
Yes, both use the treasury share method. The idea is you assume the proceeds received from exercising the options are used to buy back company shares at the average market price during the period.
So you don't just add all the option shares.
No, you only add the net increase the shares issued minus the shares assumed repurchased. It's often called the bonus element. Only the shares you issue for free, in effect, are dilutive under this method.
And conditional options.
Treated like potentially contingently issuable shares under both.
Are there any adjustments to the exercise price assumed in this method?
Yes, under both you adjust the assumed proceeds. You add the fair value of any future goods or services tied to share-based payment arrangements. US GAAP gives a bit more detailed guidance on handling estimated forfeitures here, which could cause slight variations.
What if a company bought options on its own shares? Purchased call options?
Excluded. Both standards agree those aren't part of the diluted EPS calculation.
Okay, now what about written put options or forward purchase contracts, where the company might have to buy back shares?
These are included if dilutive, meaning the exercise or forward price is advantageous compared to the average market price. Both use the reverse treasury method.
Reverse, how does that work?
It assumes the company needs to issue new shares at the beginning of the period at the average market price to raise enough cash to fulfill the put or forward contract obligation. The dilutive effect is the difference between shares assumed issued and shares to be repurchased. So you add the net number of shares assumed issued.
Exactly, if it's dilutive. But remember that US GAAP exception for forward contracts requiring physical settlement of a fixed number of shares, they follow their specific basic EPS treatment path.
Right. And partly paid shares that don't get dividends.
Treated like options for diluted EPS under both. The unpaid balance acts like the exercise price.
What if the company chooses settlement in cash or shares?
Both presume share settlement if it's dilutive. That's the default assumption. US GAAP, however, allows overcoming this presumption for liability classified share-based payments if there's a clear policy or practice of cash settlement.
And if the holder gets the choice.
Then both standards require using whichever outcome, cash or shares, is more dilutive. US GAAP again presumes share settlement if it's more dilutive, but with that same potential override for liability classified share plans based on past practice.
Okay. Convertible securities, bonds, preferred stock.
Both use the if converted method, assume conversion at the start of the period, or issue date if it's dilutive, adjust the numerator for saved interest or dividends after tax, and add the potential new shares to the denominator.
Now, here's a big one flagged in the source. Contingently convertible debt with a market price trigger.
Yes, this is a major difference. US GAAP is very specific.
Where?
These must be included in diluted EPS if they're dilutive based on the if converted math, regardless of whether the market price trigger has actually been met during the period.
Wow, okay. So US GAAP assumes conversion even if the condition isn't met yet.
For this specific type of instrument, if it would be dilutive if converted, yes. IFRS has no such specific rule, so practice might vary. Companies might wait until the trigger is met. This can definitely lead to different diluted EPS numbers.
That's a really key takeaway. How about general contingently issuable shares in diluted EPS?
For diluted EPS, both include them based on the number of shares that would be issuable if the end of the reporting period were the end of the contingency period, assuming current conditions persist.
Even if the conditions aren't fully met yet.
Yes. For diluted EPS, you factor in the shares that would be issued based on the status at the reporting date. This applies from the start of the period or the agreement date, whichever is later.
And share awards vesting based on performance or market conditions.
Both treat those as contingently issuable shares for diluted EPS. Apply the same logic.
What if the contingency is tied to earnings targets?
Both base the diluted EPS inclusion on the earnings achieved at the reporting date. US GAAP adds a clarification. Assume that current earnings level continues for the rest of the contingency period.
And if it's based on the stock price.
Both use the market price at the reporting date to determine the shares included. But again, keep that US GAAP exception for contingently convertible debt in mind.
Okay, we've covered calculation. When do companies need to go back and adjust prior period EPS figures? Retrospective adjustments.
Both require this for transactions that change the number of shares without changing resources. Think stock splits, stock dividends, bonus issues, rights issues where the exercise price is below market.
So if a company does a 2-for-1 stock split,
You have to go back and adjust all previously presented EPS figures as if the split had always been in effect. For comparability, this applies even if the split happens after the reporting date but before the financials are issued.
but not for actual conversions of options or convertible debt.
Correct. The actual conversion of potential shares doesn't trigger a retrospective restatement under either standard.
Interesting edge case. Distributions where shareholders can choose cash or shares of equal value.
Yeah, a slight difference here. IFRS tends to view this prospectively, like an exchange for value. Unless the shared dividends value is clearly higher than the cash, then the bonus and element might need restatement.
And US GAAP.
US GAAP explicitly treats the stock portion as a prospective stock issuance, not usually a restatement trigger.
Okay. And if assumptions change later, like market price or whether a contingency is met, do you restate diluted EPS?
No, both agree diluted EPS is not restated for subsequent changes in assumptions. It reflects conditions and assumptions at the time.
And share transactions happening after the reporting period ends.
Not adjusted for in the EPS figures for the period just ended, under both. Unless it's one of those no-resource change events like a stock split. Other post-balance sheet share transactions are disclosed in the notes.
Right. Finally, presentation and disclosure. We know basic and diluted must be prominent on the income statement for each class. What else?
A key requirement under both is a reconciliation. You need to show how the earnings number used for basic and diluted EPS ties back to the overall profit or loss reported for the parent company.
So users can see the adjustments made for preference, dividends, etc.
Exactly. And similarly, a reconciliation of the weighted average shares used. Transparency.
What about showing EPS based on alternative, maybe company-specific earnings measures, non-GAAP EPS?
Both allow this in the notes, not on the face of the income statement. But crucially, you must use the same denominator, the same weighted average share as required for the official basic and diluted EPS.
Any big differences in allowing these alternative measures?
Yes. US GAAP explicitly prohibits presenting cash flow per share. IFRS doesn't have that specific ban. Also, for US registered companies, the SEC has much stricter rules limiting how these non-GAAP measures can be presented and reconciled.
Okay, so bringing this all together, what's the main takeaway?
I'd say the fundamental principles of EPS calculation and presentation, they're largely aligned. The basic ideas are similar between IFRS and US GAAP.
But the devil's in the details.
Definitely. We've seen some really crucial differences, haven't we? Particularly around potential dilution, how options, convertibles, and especially those contingently convertible instruments are handled. Also, contingently issuable shares and some retrospective adjustment nuances.
And understanding these differences is, well, vital if you're comparing companies reporting under different standards.
Yeah.
You can't just take the final EPS number at face value.
Absolutely not. You need to know which standard is being used and be aware of these potential points of divergence. It impacts comparability.
So for listeners wanting to dig even deeper,
The source documents themselves, IAS 33 for IFRS and ASC 260 for US GAAP, are the definitive guides. Or looking at real company financials prepared under each standard and seeing how these rules play out can be very insightful.
which leads to a final thought, really. Given all these complexities we've discussed and the fact that the same company could potentially report different EPS figures under IFRS versus US GAAP, how much weight should you, as an investor or analyst, place solely on this single metric when evaluating a company?
It's a powerful metric, no doubt, but it's just one piece of the puzzle, right? Understanding how it's calculated and its limitations is just as important as the number itself.
Definitely gives you something to think about beyond just that headline number. Thanks for joining us on this deep dive.